Picture this. You wake up tomorrow morning, check your phone, and discover that a single company now controls more wealth than the entire economies of Germany and Japan combined. Not Apple, not Microsoft, not Amazon. A company so powerful that it owns pieces of virtually every major corporation on Earth, yet most people couldn't pick its CEO out of a lineup. This isn't science fiction. This is happening right now, and the story of how we got here reveals something profound about the invisible architecture of modern wealth. In the heart of Manhattan, nestled among the gleaming towers of finance, sits an unassuming building that houses what might be the most influential company you've never heard of. While millions of people argue about tech billionaires and oil executives, the real power flows through the corridors of firms that manage not billions, but trillions. And at the center of this hidden empire stands a single entity controlling $8 trillion in assets. 8 trillion. That's more money than most nations will see in a century. But here's where the story gets interesting. This isn't about a traditional company that sells products or services. This is about something far more sophisticated, far more pervasive. We're talking about asset management on a scale that would make ancient emperors weep with envy. While you were watching Netflix or scrolling through social media, these financial giants were quietly building the most concentrated pool of economic influence in human history. The numbers alone tell a staggering tale. 3 firms now control over $15 trillion in combined assets. That's more than 3/4 of America's entire economic output. But unlike the robber barons of the past, who built railroads and steel mills, these modern titans operate through a different kind of power. They don't own the companies directly. Instead, they control the voting rights, the decision-making power, the very heartbeat of corporate America. Think about your favorite company, the smartphone in your pocket, the streaming service you love, the car you drive. Chances are overwhelming that one of these asset management giants is among the largest shareholders, not just in one company, but in virtually all of them. When researchers examined the 500 largest companies in America, they found something remarkable. These financial titans appear as top shareholders in over 90% of them. This didn't happen overnight. It's the result of a concentration of influence quiet revolution that began decades ago, built on a simple but brilliant insight about human behavior and money. While individual investors chased hot stocks and tried to time markets, these firms offered something different. They promised to buy everything, hold everything, and charge almost nothing for the privilege. It was passive investing taken to its logical extreme, and it worked beyond anyone's wildest dreams. The beauty of this system, from their perspective, is its invisibility. When you invest in their funds, you're not just buying stocks. You're handing over your voting rights to decisions that shape entire industries. Every shareholder resolution, every board election, every major corporate decision flows through their proxy voting departments. It's democracy by delegation, and most people don't even realize they've signed away their voice. But here's what makes this story truly fascinating. These aren't evil masterminds in smoke-filled rooms plotting world domination. They're bureaucrats managing other people's retirement money, teachers' pensions, your grandmother's 401k, university endowments, sovereign wealth funds from around the globe. The money isn't theirs, but the power absolutely is. During the financial crisis of 2008, when banks were collapsing and governments were scrambling for solutions, who did they turn to? Not other banks, not traditional Wall Street firms. They turned to these asset management giants, asking them to untangle the toxic mess that had brought the global economy to its knees. When the pandemic struck and markets froze, the Federal Reserve didn't just cut interest rates. They handed over unprecedented authority to buy corporate bonds to the same firm that already managed more money than most countries produce in a year. What we're witnessing isn't just the concentration of wealth. It's the concentration of financial decision-making power on a scale never before seen in human history. And the most remarkable part? It happened while everyone was looking the other way, focused on the flashy personalities and dramatic headlines, while the real transformation occurred in the shadows of asset management. The question isn't whether this system is good or bad. The question is whether we understand what it means when so few control the financial fate of so many. Because understanding this hidden architecture of power isn't just about money. It's about recognizing how the world actually works beneath the surface of the stories we tell ourselves. The mechanism behind this concentration reveals itself when you follow the money backward. Every month, millions of Americans contribute to their retirement accounts. Teachers, firefighters, office workers, all dutifully setting aside portions of their paychecks for a future they hope will be secure. That money flows into index funds, those seemingly innocent investment vehicles that promise to track the market's performance at rock-bottom fees. But here's the sleight of hand that most people never see coming. When you buy shares in an index fund, you're not just investing in the stock market, you're transferring your voting rights to the fund manager. Every corporate decision, every board election, every shareholder resolution that shapes how companies operate gets decided by a handful of asset managers using your money. It's taxation without representation, dressed up as financial innovation. The scale becomes staggering when you realize that passive investing now accounts for more than half of all stock market assets. Trillions of dollars flowing through index funds that automatically buy stakes in virtually every publicly traded company. The fund managers don't pick winners and losers. They buy everything and hold forever. But that seemingly passive approach creates active power over corporate America that would make the railroad tycoons of the 19th century jealous. Consider what happened during the pandemic, when entire industries teetered on the edge of collapse. Airlines, hotels, retail chains, all facing potential bankruptcy. Who stepped in to provide stability? Not government bailouts alone, but the steady buying power of index funds that continued purchasing shares even as prices plummeted. These asset management giants became the ultimate stabilizing force, not through conscious strategy, but through the mechanical process of collecting retirement contributions and deploying them across the market. The irony cuts deep. Individual investors, terrified by market volatility, sold their stocks and fled to cash. Meanwhile, the index funds they contributed to through their employers kept buying, creating one of the greatest wealth transfers in modern history. Those who panicked and sold directly lost fortunes. Those who stayed in index funds through their retirement accounts saw their balances recover and reach new highs. The asset managers, collecting fees on both the selling and the buying, profited regardless of market direction. This dynamic reveals the true genius of the system. These firms have created a machine that generates wealth and influence whether markets rise or fall. During bull markets, asset values soar and management fees multiply. During bear markets, they buy assets at discounted prices while collecting the same percentage-based fees. They've built the financial equivalent of a hydroelectric dam, capturing energy from the flow of money in both directions. But what happens when this concentration of control meets corporate governance? The answer reshapes entire industries without most people noticing. When these asset management giants vote their shares, they're not just influencing individual companies, they're setting standards across whole sectors. Environmental policies, executive compensation, board diversity, strategic direction, all get decided by proxy voting departments managing trillions in other people's money. The pharmaceutical industry provides a telling example. When these asset managers vote their shares in drug companies, they're simultaneously voting shares in insurance companies that pay for those drugs and hospital systems that administer them. They own stakes in the entire healthcare supply chain, creating conflicts of interest that would have been unimaginable in previous eras of capitalism. The same dynamic plays out in energy, technology, finance, every sector where these giants hold significant stakes. Yet the most remarkable aspect remains how invisible this transformation has been to the general public. While headlines focus on flashy tech entrepreneurs and controversial political figures, the real power accumulates quietly in conference rooms where proxy voting decisions get made. No dramatic announcements, no hostile takeovers, just the steady accumulation of influence through the mundane process of collecting retirement contributions and deploying them across markets. The beneficiaries of this system aren't necessarily the asset managers themselves, though their profits are substantial. The real winners are those who understand how the system works and position themselves accordingly. institutional investors who can access wholesale investment products, wealthy individuals who can diversify beyond simple index funds, corporate executives who align their interests with these mega shareholders rather than fighting them. This creates a feedback loop that reinforces existing power structures while appearing democratically accessible. Anyone can invest in index funds, but not everyone understands the implications of doing so. The complexity provides camouflage for a system that concentrates decision-making power while distributing the illusion of ownership across millions of individual accounts. The question that emerges isn't whether this concentration will continue. The trends suggest it's accelerating as more money flows into passive investment strategies. The question is whether societies will recognize what they've created and decide whether the benefits outweigh the risks of having so much corporate control concentrated in so few hands. History teaches us that the greatest transformations often happen not through revolution, but through evolution so gradual that entire generations miss the shift until it's already complete. The concentration of financial control we've witnessed represents exactly this kind of transformation. Not a conspiracy, but a convergence of technology, regulation, and human behavior that created something unprecedented in the annals of economic history. The $8 trillion company you've never heard of isn't really about one company at all. It's about a system that emerged from the intersection of retirement planning, financial innovation, and the basic human desire for security. Millions of people making rational individual decisions that collectively created an outcome none of them intended or fully understood. What matters now is not whether this system is inherently good or evil, but whether we recognize it for what it truly represents. The quiet reshaping of capitalism itself, where ownership becomes distributed, but control remains concentrated. Where democratic participation in markets exists alongside oligarchic influence over corporate decisions. Understanding this hidden architecture doesn't require fear or outrage. It requires curiosity about how power actually flows through modern economies. Because when you understand the system, you can navigate it more effectively. When you recognize the currents beneath the surface, you're less likely to be swept away by forces you never saw coming. The story of these financial giants reminds us that the most important economic changes often happen in plain sight, disguised as mundane innovations that promise convenience and efficiency. History shows us that those who thrive are not necessarily those who resist change, but those who understand it first. This content is for educational purposes only and does not constitute financial, legal, or investment advice. If you enjoy learning how history and money intertwine, subscribe to Empire Economics for more untold stories.